It's my feel-good breakfast show. According to the South African Insurance Crime Bureau, vehicle-related theft is on the increase. This increase applies to both vehicles stolen during home robberies and hijackings. With this in mind, can you afford to be without car insurance? Here to tell us more, we've got Casey Rousseau from First for Women in studio. Casey, good to have you back with us again.
Hi, Leigh-Anne, thank you.
So now we know that we have to have car insurance, but how do we know what car insurance to get?
So there are three different types of car insurance policies that First for Women offers. The first car insurance policy is a comprehensive car or vehicle insurance policy. The second is a third-party fire and theft insurance policy. And the third option is a third-party insurance policy. With regards to the comprehensive car insurance policy, this provides cover when you are in an accident or if your car is stolen or if you cause damage to someone else's car or property. With regards to third-party fire and theft insurance policies, you are covered in the event of your car being stolen or if it is damaged by fire, and also if you cause damage to a third party's car or property. And our most basic car insurance policy is a third-party policy, which provides cover in the event of you causing damage to someone else's car or property.
Now, Ewan and I were just talking about the different insurance rates, how much he pays, how much I pay. How does the insurance company calculate the car insurance rate?
There are numerous factors that your insurer will take into account when determining what the rate is that you pay on a monthly basis, which is why it's also critical that the information that you provide your insurer is correct, because if you don't, you might be paying the incorrect rate. So the factors that an insurer would look at are things like what make of car it is that you're driving, what model it is, where is it kept during the day, where is it kept at night, who is the driver, is it used for business or in a personal capacity. Other factors that insurers will look at is how susceptible your car is to theft. So, for example, cars that are more common on the road and their parts are easier to obtain are likely to be bigger theft risks. Other things that insurers will look at is the safety record of the model and also the cost to replace or repair any of the particular parts.
Okay, so here's another big one. How much car insurance cover do I actually need?
So the first thing that you need to do is determine what insurance policy you need for your car. Once you've determined what that is based on what your needs are, then you need to calculate what the value of your car is. And many South African motorists suffer financial loss because the value of their car isn't insured at the correct rate. So there are three values that your car could be insured at, and that being either the trade value, the retail value, or the market value. All three of them actually have pros and cons, so it's important for each individual to evaluate what they are and see whether they're in line with what their needs are. So the first value would be the trade value, and that is the value of the car or the amount that you would get if you were to sell your car to a dealer. The retail value is more applicable for new cars, so this would be the value that you purchased your car at, that you would insure it for. And then the market value is the average between the trade and the retail value, and this is applicable to cars who are generally 2 years or older. And one way of determining what the market value of your car is to go and have a look at an up-to-date car magazine and see what cars that are similar to yours in terms of the make and model, what they're being sold for, and you can use that to determine what your vehicle's market value should be. The important thing, though, is to make sure that you don't underinsure your car. So the value of the car is correct when you speak to your insurer, so that if you ever do need to claim, the two match up to each other.
So Casey, lastly, I just wanted to know from you, why does my premium increase yearly when the value of my car depreciates?
So this is actually quite easily explained. Most short-term insurance policy holders assume that their monthly premiums are based on the value of their car, and that the biggest risk to them and the insurer is their car being stolen or it being damaged in an accident and written off. However, very few cars are actually written off after being in an accident and are fixed and put back onto the roads. What plays a major role in determining what your monthly premiums will be is the cost to replace or repair specific parts. In the past, a car would be sent to a panel beater and it would be fixed through the panel beater. But because cars are far more modern today and far more sophisticated, there's a lot of technology that goes into a lot of the parts. So for example, having a sensor on a bumper that helps with park distance control will be very, very expensive. Also, something else to take into account is that many vehicles on our roads are imported, and as such, their parts need to be imported as well if that particular car parts need to be repaired or replaced. Our exchange rate, the increasing cost of petrol and transport all play a role in determining the cost of these particular parts, which results in them increasing. So although a car may depreciate between 10 to 15% per year, for example, in order for it to be financially viable for an insurer to cover the cost associated with the damage of the spare parts, your insurance premium needs to either remain similar or be increased.
Wow. So much to take into consideration, hey? That's why I'm so happy that you're here sharing these insights. Thank you so much, Casey. We will, of course, continue these conversations every Thursday.
Thank you, Leigh-Anne.